In the world of investing, patience is not just a virtue, it's a winning strategy. The ability to think long-term can be the difference between financial success and failure. It requires a mindset that looks beyond the immediate gains and focuses on the bigger picture. Short-term thinking often leads to chasing the latest trends, buying high and selling low. This approach is driven by emotions and the desire for quick profits, which can be detrimental to your financial health. This emotional roller coaster is a recipe for underperformance. Constantly reacting to market fluctuations can lead to poor decision-making and missed opportunities. Long-term investors, on the other hand, understand that true wealth is built gradually, brick by brick over decades. They recognize that the market's short-term volatility is just noise in the grand scheme of things. Long-term investing minimizes risk by allowing you to ride out the inevitable market fluctuations. By staying the course, you give your investments the time they need to grow and recover from downturns. The stock market is like a roller coaster with its ups and downs, but unlike a roller coaster, the market's long-term trend has historically been upward. However, over the long term, the trajectory of the market has always been upward. This upward trend reflects the growth of the economy and the innovation of businesses. By staying invested and not panicking during downturns, investors can benefit from the power of compounding. Compounding allows your investments to grow exponentially over time, turning small contributions into significant wealth. Remember, time is the friend of the wonderful company and the enemy of the mediocre. Investing in high-quality companies and holding them for the long term can lead to substantial returns. When you invest for the long haul, you align yourself with the growth of the economy, the innovation of businesses, and the power of compounding. This approach not only builds wealth but also provides financial security and peace of mind. History is replete with examples of investors who got caught up in the frenzy of the moment, driven by the allure of quick profits and the fear of missing out, only to regret their decisions later. One such cautionary tale is the South Sea Bubble of 1720, a financial disaster that left a lasting mark on economic history. Investors, blinded by greed and the promise of quick riches, poured their savings into the South Sea Company, a British joint stock company. The company promised untold wealth from trade with the South Seas, a promise that was too good to be true. The company's value soared to astronomical heights based on speculation and hype, not on sound fundamentals. The stock prices were driven higher and higher by rampant speculation, creating an unsustainable bubble. People mortgaged their homes and sold their possessions to buy shares, convinced they were missing out on a once-in-a-lifetime opportunity. The frenzy reached a fever pitch as everyone wanted a piece of the action. However, the bubble eventually burst, wiping out fortunes and leaving countless investors in financial ruin. The collapse was swift and brutal, exposing the fragility of the speculative mania. The South Sea Bubble serves as a stark reminder of the dangers of short-term thinking and market timing. It highlights the perils of investing based on hype rather than solid financial principles. Those who tried to time the market, buying at the peak and selling at the bottom, lost everything. The panic selling only exacerbated the crash, leading to even greater losses. Those who held on to their investments for the long term, however, eventually recovered their losses and even profited. The lesson is clear: patience and a long-term perspective are crucial in the world of investing. Let's look at a hypothetical example to illustrate the power of long-term investing. Imagine you invested $10,000 in a low-cost S&P 500 index fund in 1980. How much do you think your investment would be worth today? Well, assuming you reinvested all dividends, your $10,000 investment would have grown to over $1 million. This remarkable growth is a testament to the power of compounding and the resilience of the American economy. By simply staying invested in a diversified portfolio of stocks, you would have participated in the long-term growth of the market, outpacing inflation and building significant wealth. Of course, past performance is not indicative of future results, but the principle remains sound. Over time, the stock market tends to go up, rewarding those who are patient and disciplined. Some investors seeking a safe haven during times of uncertainty turn to gold. While gold can act as a hedge against inflation, it doesn't have the same growth potential as productive assets like stocks. Gold doesn't produce anything. It doesn't generate earnings or pay dividends. Imagine you had invested $10,000 in gold in 1980. While your investment would have appreciated in value, it would have significantly lagged behind the returns of the S&P 500. This is because gold's value is largely driven by sentiment and fear, not by its underlying fundamentals. While it's wise to have a small allocation to alternative assets like gold in your portfolio, it's important to remember that the real drivers of long-term wealth creation are businesses that innovate, create jobs, and generate profits. You don't need to be a financial wizard or have access to sophisticated trading strategies to be a successful investor. In fact, one of the simplest and most effective ways to invest is through low-cost index funds. An index fund is a type of mutual fund or exchange-traded fund, often referred to as an ETF, that tracks a specific market index such as the S&P 500. Index funds offer several advantages for long-term investors. First, they provide instant diversification by investing in a basket of stocks, which reduces your exposure to the volatility of any single company. Second, they typically have lower fees than actively managed funds, which can eat into your returns over time. Lower fees mean more of your money stays invested and working for you. Third, index funds remove the emotion from investing. You're not trying to pick individual stocks or time the market, you're simply buying and holding a diversified portfolio of companies that represent the broader economy. This approach allows you to benefit from the overall growth of the market. Over time, the stock market has historically trended upwards, despite short-term volatility. By staying invested in index funds, you can ride out the ups and downs and potentially achieve solid returns in the long run. So, if you're looking for a straightforward, low-cost way to invest, consider index funds as a cornerstone of your investment strategy. Section 6. Time. Your greatest ally in the market. In the world of investing, time is your greatest ally. The longer you stay invested, the more time your money has to compound. Compounding is the snowball effect of earning returns on your returns, leading to exponential growth over time. Imagine a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, growing larger and larger. The same principle applies to investing. The earlier you start investing, even with small amounts, the more time your money has to compound and grow into a substantial sum. Don't underestimate the power of starting early and letting time work its magic. Even if you can only invest a small amount each month, the consistency and the power of compounding will work in your favor over the long run. Section 7. Tuning out the noise. A recipe for investment success. The financial markets are constantly bombarded with news, opinions, and predictions. It's easy to get caught up in the noise and make impulsive investment decisions based on fear or greed. However, successful investors know how to tune out the noise and focus on their long-term goals. Remember, the stock market is not a casino. It's a mechanism for owning a piece of great American businesses. Instead of trying to predict short-term market movements, focus on identifying companies with a durable competitive advantage, a strong management team, and a track record of profitability. By sticking to your investment philosophy, ignoring the noise, and staying disciplined, you'll be well positioned to weather any market storm and achieve your long-term financial goals. Section 8. The enduring strength of the American economy. Despite its challenges, the American economy has always demonstrated remarkable resilience and an unparalleled ability to innovate and adapt. From the Industrial Revolution to the digital age, America has consistently been at the forefront of progress, creating immense wealth for its citizens. When you invest in the American stock market, you're investing in the ingenuity, creativity, and entrepreneurial spirit of its people. You're betting on the long-term growth of the economy, the continued innovation of its businesses, and the enduring strength of its institutions. While there will always be periods of uncertainty and volatility, history has shown that those who bet against America have consistently been proven wrong. By staying invested in the American dream, you're positioning yourself to benefit from its continued success. Section 9. Building a legacy through long-term investing. Long-term investing is not just about accumulating wealth, it's about building a legacy for yourself and your loved ones. It's about securing your financial future, funding your dreams, and leaving a lasting impact on the world. By adopting a long-term investment mindset, you're making a conscious decision to prioritize the future over the present. You're choosing to delay gratification today in order to reap the rewards of compound growth tomorrow. And in doing so, you're creating a brighter future for yourself and generations to come. Remember, the greatest investment you can make is not in the stock market, but in yourself. Invest in your education, your health, your relationships, and your community. These are the investments that will pay dividends for a lifetime and beyond.